Starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that.
We are getting the closing bells here in New York. I do want to point out, too, equity option volume from both stocks and indices looks like it has actually hit a record high. It'll take a little bit while for us to get the final numbers on that. But remember, yesterday was the second most active day in the equity options market on record. And it looks like today has surpassed that to overtake a record that was set back a few years ago. The Dow Jones Industrial Average that you're looking at on your screen right now, closing out the day lower by 5.5%.
The S&P dropping another 6% today, now down more than 10% since President Trump announced his sweeping tariff plans Wednesday night. The benchmark index losing $5 trillion in market cap in that period, putting it its worst two-day drop and its worst week since March 2020. It also closed at its lowest level since last May. The Dow dropping more than 2,200 points, its third biggest point drop in history, and nearly 4,000 points in 2 days. The Nasdaq also sinking 6% with massive losses in Tesla, Nvidia, and Apple. Tesla, in fact, has been cut in half from its record high. Apple dropping below the $3 trillion market cap mark for the first time since June.
All right, welcome to Power Lunch's stocks and your money continue to fall. The Dow is down 1,534 points. 12 months gains close to being wiped out, or even wiped out if you're technology stocks.
I don't want anything to go down, but sometimes you have to take medicine to fix something. And we have such a horrible, we have been treated so badly by other countries because we had stupid leadership that allowed this to happen.
All right. Today's Sunday, the 6th of April. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. And shall we say, what a week it was. Unbelievable. Or for some it is believable because they've been paying attention, they've been watching the show. There are no surprises at all. But to say the least, the week was ugly. It's a week where the Dow Jones closed negative by almost 8%.
Oof, madon.
And the S&P 500 down by more than 9%.
Oh my God!
While the tech-heavy Nasdaq was down almost 10% for the week.
Oh.
And folks, if you thought that we have any relief overnight in tomorrow's session, not at all. Last time I checked here, the futures are down anywhere between 3 to 5%. Of course, that's going to change by the time you watch the program, but nonetheless, it is in ugly open, at least expected to be, and then we'll see what happens. But the damage is huge, folks. The NASDAQ 100 is now officially in a bear market, a call that we made before the year even began in this show, while the S&P 500 wiped out $5 trillion in 2 days. Poof, gone, goodbye. Of course, you folks know that there is no such thing as poof, gone. The money's just going to transfer hands from the dumb to the smart, aka the insiders, the oligarchy, you know the deal. More on that in a minute, but rest assured, folks, the president says that when asked, the market are way down, the worst day in years. The president responded by saying, I think it's going very well. So rest assured, if you grab your delusional glasses on, the market is doing fine. Better than ever before. Now, an important question here, folks. Why did we snap? Because the market was going down. We all knew about the recession fears and all of that, coming from, of course, the tariff policy. But what caused the market to snap? What was the indicator to give us that, hey, watch out, this is going to begin to crash now? I issued a morning brief on my Discord, dated April 3rd, and in it I said the most important part, as a result of this chaos, after talking about the Trump tariff policy, as a result of this chaos, the dollar is crashing along with bond yields. That's a recession mode. But the interesting part is even gold crashed overnight. This behavior suggests panic, and perhaps investors will exit gold to chase the ultimate safety route of bonds. This is really important because you can have the market going down and gold going up for a little while. And usually 9 times out of 10, that's actually a buying opportunity because folks are just parking the money in gold, awaiting clarity in the stock market. Then we see a rotation back into the stock market. But when we see that kind of, let's say, a little bit of fear morphs into panic, then we get into crash mode. And crash mode, we see folks dumping their gold along with their equities and chasing bonds or cash. Anyhow, under such circumstances, market declines can be rapid and steep. That's a common mistake traders will make today, is thinking that the market is oversold, and they'll wait before hedging or betting against the market only to watch what's been oversold, getting even more oversold. This is exactly what happened. This is why I told the members of this channel, the strategy right now is the following: balls, brains, aggression, and maturity. You can't navigate anything in life, let alone trading, without balls. So if you don't have those, you got a problem already. Number 2, your brains. Did you do the homework? Did you do the analysis, such as I did in the morning brief? And then that leads to number 3, which is the aggression. You did the homework, you got your balls intact. Now it's time to fire up the big guns because things are aligning according to your analysis for a major drop down. Number 4 is maturity, which is at some point, you got to be mature about it, that it's going to come to a point where it's really, really oversold and we're going to see rebounds. So you have to know when to book your profits. And my analysis when it comes to gold stems from gold versus oil. When we see gold and oil crashing down together, usually that happens during, let's say, a systemic risk or credit risk, aka a crash. So you see right now, most recently, in the aftermath of the tariffs, you're looking at gold, of course, in yellow, and then you're looking at crude oil in white. They've been crashing together. That's a huge warning sign that be careful here. This could get uglier. Whatever rebounds we get in the market, they're going to be short-lived. You see the same phenomenon when we got the SVB collapse, the regional banks, gold and oil went down together. In the 22 bear market, we've seen oil and gold also crashing together. That's when we hit the panic phase of any correction or crash. Usually that happens. If you go back in time, you'll see that we have other episodes. For example, in 2020, an important distinguish was oil crashed during the great panic of the pandemic. Oil crashed, but gold moved higher. That's stage number 1 of hedging against any fear, is you dump oil, you dump some equities, you go ahead and park your reserves in gold. But at some point when things get really, really dire, you got to exit gold. So you see gold crashing down with oil and the stock market. Otherwise, if you see gold coming down and then oil recovering and the stock market also doing a recovery, then you know that the worst is behind. And this is exactly what happened in 2020. Now, we can see another episode in 2018 when the Fed was raising rates. Oil crashed down, indicating that by raising rates, you're going to increase the possibility of a recession. Investors, of course, to hedge against a recession, began buying gold. And at no point we've seen oil and gold crashing down together. So the worst was behind us once the Fed backed off and everything was normal. So again, you have to really watch and be careful of the periods when we see gold and oil crashing down together. It is really important to know which period of the correction or the crash you're in. If gold is going higher, market going down, oil going down, okay, that's just a sort of a resource to safety. Let's just park, wait and see. But when they begin dumping gold and oil together, you got to be really careful because you see what happened here. We go back in time, the 08 crash, the great rally in oil came to a halt and it began crashing down along with gold as investors shifted to the ultimate safety of bonds and the dollar. Of course, times could change and what was safety back in 08 might not be safety today, such as the dollar. We'll see. But it is important when folks exit gold and they start to look for, let's say, stronger hedge. That's usually a warning sign that we have a big flush. And by the way, you see all of these option bets against crude oil Brent. It's absolutely insane, all-time highs. So when they're being bearish against oil, what are they saying in essence? They're betting on a recession, and not just a U.S. recession, but a global recession. So once again, oil is going to be a really important indicator from this point on, because if you see rebounds in oil or bottoming patterns in oil, you'll know that we're ready for a rebound at least. But when oil begins to go down again, we have a resumption of the recession fears, and that's not going to bode pretty good for the stock market. Now we look at the heat map for the week here for the ETFs. Everything got slaughtered. Even the stagflation portfolio, even the defensive names Like the XLP, for example, the staples went down, although outperformed the rest of the market, but needless to say, everything is down. And you see the shift. The shift is GDX gold miners down over 8.5%. Now you got GLD gold, the commodity, down about 1.5%. When that happens, when they begin to exit and they buy the TLT instead, which was positive for the week, that's usually saying, watch out, they're selling in mass, we're crashing, and you see it right in front of you here. So we need to see a reversal of all of these dynamics before we have a confirmation that we got a solid evidence for a rebound. On Friday's session in the morning brief, I gave you this, the mini futures. If it fails at 5,300, because that was the target for the week that we gave you in last weekend's video, where we got this target, 5,300 in the S&P mini futures. But if we fail at that point, it looks like we're going to go down in an inverse ABC pattern. And this is exactly what happened, folks. Look at this. Overnight right now is just ugly, ugly, ugly. We're trading at least, at the time of the recording of this program, below 5,000 in the E-mini futures. We're going to look at the charts in a minute here, folks, in the conclusion of the program and see what's going on. But the voices are getting louder that what we're seeing right now is eerily similar to what happened in the crash of 1987. Even the charts look pretty much identical. We know that 87 was one of the most ugliest crashes in stock market history. It happened rapidly, and it happened big, and it looked like the world was ending. It took a long time to get out of it and recover. If that is the case, if we're in an 87 crash, then tomorrow's probably going to be an ugly day, and perhaps the rest of the week without a rescue. And the only rescue right now is the president backing off the entirety of the Trump tariff policy, saying, okay, I made a mistake. My bad, let's back off and take everything we put on the table. Now, use your head. Is President Trump really going to do that? Of course not. I don't want you to lose hope here, folks, because we got hope. You got your boy Jim Cramer. He's the one who floated the 87 idea that we're going to have Black Monday again. So maybe not going to happen. Although I would say to Jimbo's credit that if you guys remember, he made an awful call with Bear Stearns in the crash of 08. But after that, he became crazy accurate. So I would say be careful when Jimbo becomes accurate. That's pretty much the ultimate sign that we're crashing. And speaking of, let's just dive right into it here, folks. In focus tonight. Economic Armageddon, baby. Before we talk about the economic Armageddon and the tariff policy and all of that, you know what I want to share with you? What's really crazy this weekend? I got so many people reaching out to me. Friends, family, a bunch of hoes I dated a long time ago. And they're asking if this is a buy the dip opportunity. This is like 2009, right? I should be buying. Which stocks should I buy? And I'm like, honey, there's something we call the hoe indicator. And in a nutshell, it means that if you're calling me, asking if it is the time to buy the dip, we're actually not done crashing, and I should be shorting the market even more. So thank you and goodbye. But it is crazy, folks. I mean, even folks, my family members, they want to buy Tesla dip and NVIDIA. You know, what are you, crazy? Like, you lost your mind? You haven't been following? But I understand why. Because we have an entire generation of investors who's been brainwashed that stocks only go up and every dip is to buy, and time in the market beats the timing in the market and whatever crap they believe in. Not realizing that every bubble act and react the same way. The higher it goes, the bigger the crash. And bubbles, in essence, a process of wealth transfer. You're gonna look back at all of this someday, and you wouldn't believe that you spent 3, 4, 5 years playing the roller coaster in the stock market. And there are moments when you looked at your paper gains and you thought you're rich, you made it with grandma's COVID money, because, rest in peace, she left you all of that money. And now you're using it to gamble in cryptos and tulips and shitcoins. But then you're going to realize that this was perhaps the most expensive roller coaster ride in history, in which trillions of dollars were transferred from someone to others. And you want to be right now in the recipient side of that process. Unfortunately, the majority of the retail investors and the retirees are going to be in the victim side of that equation, where their money is sucked and transferred. More on that in a minute. But again, the minds are polluted by some donkeys in social media or some frauds who became stars again because they found a new generation of donkeys to scam. These are the people that retail investors listen to. And this is why they're going to get annihilated. Listen, for example, to your boy Tom Lee, one of the most favorite analysts in the donkey community. He said before the month began, odds of a V-shaped recovery in stocks that come after April 2nd is extremely high. But the only V-shaped recovery that I see is in the portfolio of the bears. In the market, on the other hand, maybe if you flip your head upside down, you'll see a V-shaped recovery. But the damage is done. Retail investors bought $4.7 billion in stocks on Thursday, the largest level over the past decade, JP Morgan says. And they got slaughtered right away Friday, and they're getting slaughtered again overnight. Ladies and gentlemen, we're not going to find the bottom until the retail investors and the hoes call me and they say, I give up. I want to sell it all. Should I just sell it all? I should get out of the market, right? That's the moment when we say, okay, we have reached a bottom. But so long as they have the mentality of, oh, we're going to buy the dip now. So long as you still got money in your account to buy the dip with, we're not done crashing. And they're all shocked, dazed, and confused, specifically the youth, the Zoomers and such. They think this is sort of a mega crash that is happening. It's not. It's a flush for now. It might get really ugly once we open the market Monday. But it's not like 2008 at all. In 2008, there was blood on the streets. It was an absolute massacre and fear and folks losing their jobs, losing hope, like we've never seen before since the Great Depression. So when you have all of these donkeys in social media saying, oh, Warren Buffett says, buy when everybody's fearful. Nobody's fearful now. They want to buy the dip. You think Warren Buffett is buying right now? Warren Buffett dumped ahead of time at the top. And he's going to wait till we have rivers of blood on the street. Then he's going to begin to buy. So please understand what fear actually means and what Warren Buffett actually said about all of these bubbles, which I showed you in last weekend's video. And they're all tapping themselves on the back for being cucks to the oligarchy and the insiders, making the billionaires richer, chasing these stocks that somehow you're going to get rich too. No, you're not. Every time you chase, somebody else gets richer. A billionaire dumps, an insider dumps. Every time you buy the dip, the billionaire gets the dump at a better price. That's what's really happening. So you got Kelly here saying if you haven't sold a single share throughout all of this, you're incredibly attractive. But they're not going to be so attractive, honey, when they lose all of their money. You're going to ghost them because they're broke. So stop bullshitting them. The problem is right here. Households are all in the stock market. They think this is the easiest way to get rich, and market is easy. The market is a video game. You just buy, and it goes up and you get rich. Same mentality we got before the crash of 29. We're not seeing blood in the streets yet when you have South Korean retail investors having the highest demand on record for U.S. equities. They've been buying the dip over and over and over again. They've been buying the falling knife over and over and over and over again. So by the end of all of this, watch out for South Korea to fall to Kim Jong-un without even firing a shot. He's going to take the whole enchilada because South Korea is going to be so broke when all of this is said and done. But folks, if you want to buy the dip or you think this is a great dip buying opportunity, not when things are crashing though. You got to be careful because we got the news that hedge funds are facing Lehman-style margin calls due to the market crash. So again, folks, if you've been watching this program, you know exactly when to close your shorts, buy some dips before you resume again if nothing changes, because I'm giving you a lot of indicators every day to look at too. Among them, of course, the gold oil indicator, looking at the dollar, bond yields, the VIX, charting the VIX, and you're not going to fall in the trap of buying a dip and then finding yourself catching a falling knife instead. I told all of my viewers throughout the week, the mantra right now, because once the market crashed down, I have a lot of bears in my Discord community. Even the bears were saying, hey, I should buy the dip, right? Today's things are oversold. We should be buying the dip. I told them throughout the week, this is not a dip buying opportunity. I just explained that to you by the gold indicator. And I said the mantra is De Niro from Goodfellas in the Christmas party when he said, don't buy anything. Don't buy any. What did I don't buy anything. Not the time to buy anything right now. You got to wait for further clarity before you even think about buying the dip. But again, folks, when we talk about dumb money rushing all in right now, buying the dip, guess what the insider's been doing? Corporate executive stock sales reach all-time highs. Again, it's a process of transferring the wealth from one hand to the other. There's nothing lost, nothing gained. Your retirement money, your pension money, your investing money is being transferred to the insiders in the companies. The CEOs, the billionaires, the oligarchy, and of course, the Wall Streeters. Your manager who keeps saying, oh, but timing the market is better than timing the market. Stay calm. We're going to buy it later on. Give me some more money. They want you to stay in the market to cash in the bonuses. The commission, motherfucker. But they don't really care about you. And furthermore, valuations, if you want to buy the dip right now and transfer more wealth to the Wall Streeters, the oligarchy, the managers, the CEOs and such, you got to be careful because, yeah, the valuations went down a little bit. The price to earnings ratios went down a little bit, but usually they're not really a generational buying opportunity until we go below the 15 rating, which we're not there yet. Of course, when we fall to 15, we have a recession. And again, the best buying opportunity is happening somewhere in a recession. Sometimes early on, sometimes later on, sometimes midway. And the reason is the stock market, of course, foresees things ahead of time. So it crashes down before the actual recession. And that leads us to a popular question over the weekend. And the question is, Mav, but the payrolls came out pretty good. We're not seeing massive job losses. We've printed about 228,000 jobs in the month of March. What recession? What are we talking about? You sound more like James McIntosh at the Wall Street Journal, who I used most of his article as toilet paper. And he said in 23, where is the recession we were promised? ? Just because it didn't happen in your timeline, let's make fun of the recession. Well, what do you got to say now? And you haven't seen a damn thing yet. Folks, it is important for you to understand the concept that I've been floating for, I would say, months, if not years for now, which is called the duality of the risk. When you have an inflation episode like we've had in 21 and all that money printing, you have to dip the economy into a recession. You have to crash the stock market a little bit to eradicate that excess inflation out of the economy. If you don't do that, you can buy time, you can play games, but all what you're going to do is increase the odds of reinflation while minimizing the odds of a recession. And then vice versa. At some point, you find yourself in a stagflation phenomenon, and the economy finally succumbs and comes down crashing altogether like a pancake because of that concept of the duality of the risk. In the pandemic, we had at least what we thought was a recession. Well, the remedy for a recession is to introduce inflation, to introduce excess, stimulus, printing of money, lowering of rates. All of that gets you out of a recession. But likewise, what gets you out of inflation? It's a recession. The sooner you accept, the better. The longer you delay and kick the can down the road, the bigger the problems and the bigger the crash. What we see right now when we talk about the duality of the risk. Let's begin again with the recession risk. You got initial jobless claims in D.C. and federal workers surging like we've never seen before. This is, of course, a result of what's happening with Doge. And when folks see a lot of their family, a lot of their friends losing their jobs, they begin to think. It begins to influence their psychology as a consumer. They begin to spend less. As they begin to spend less, more and more businesses get weaker, and they have to get rid of their employees too. And that's how we have psychology leading to an actual recession. And right now, share of consumers who expect higher unemployment over the next year is surging to highs we haven't seen unless we were in a recession. But we must ask the question here, folks. Is it really worth it? Is what we're doing right now worth it or not? Because when you look at Doge saving, in February 17th, they said that we've saved $16.5 billion. But they keep revising those down to $7.2 billion. And nobody really knows if we're saving anything, if all, with the lunacy of Elon Musk or whatever he's doing. Do we have excess in the government that needs to be trimmed? Sure, but you need a plan for that. You can't just close departments suddenly and get rid of tens of thousands of employees randomly. It has to be an orderly process to prevent these kind of shocks in the economy. When we talk about the psychology of the consumer sentiment index is plunging. And when we see these kind of plunges, either we have a bear market or a recession. The probabilities of a recession. Look at the difference here between the black bar, which is November 24, and the yellow bar, which is March 2025. The 5-year treasuries, for example, were placing a recession odd of 45% in November. In last month of March, placing those odds at 52%. You can see it across everything pretty much. I mean, you have the Russell 2000. Russell 2000 was placing in 1% chance of a recession in November. Now it's placing a probability of 48%. That's the change in sentiment. That's the change in psychology that is now flooding the market. And you have to remember, yes, you might look at, but we're not seeing a lot of jobs being lost. We printed 228,000 jobs last month. Yes, but the market crashes before the actual recession. The market looks forward. The market tries to anticipate things ahead of time. And right now, it's not seeing good things. Among the recession indicators, you look at home builders' inventories, unsold inventories. And these are for new homes. The number continues to surge higher, and that's always an indicator that a recession is about to hit, and a crash in the housing market is about to hit. Furthermore, with all of this uncertainty, a lot of folks have been asking another question, because one of the most profitable trades that I've made this week, produced millions of dollars, is betting against JP Morgan using weekly puts and bi-weekly puts. And of course, the market maker is not pricing the premiums for a stock that is usually boring like JP Morgan as to experience such volatility. So that was the opportunity. You buy the puts cheap, JP Morgan crashes, you make a shit ton of money. But the question is, why do we see the banks crashing right now? Look at the loan issuance. It continues to decline. And so far, it looks anemic for the month of March. What does that mean? If they're not lending, they're not making money. Why are they not lending? because nobody wants to take a loan right now. With the uncertainty, with the tariffs coming in, with the possibility of a recession, why would you take a loan right now when you could take it later on for a cheaper rate? That's going to impact the banks negatively. And here's another recession signal for you. 6.1 million Americans are behind on their mortgage. FHA delinquencies just hit 11.03%, the highest in years and higher than the great financial crash. Doesn't look good, folks. See, when we were pointing out all of these information for you in the last couple of years, you said that we're just perma bears and doom and gloom and all of that, but we were warning you about things building up in a negative way. And you only need the spark, and the spark finally came with the trade war, to blow the whole thing up. And then whatever you call as generational gains get wiped out so fast, poof, gone, as we see right now. Furthermore, credit spreads are now getting really scary and dangerous. I told you before that in the beginning you're going to see wreckage in the stock market, but it's benign. We're going to rebound and recover if we don't see credit spreads moving. But if they begin to move, we're now at the crash kind of phase. And it got worse, by the way. This is kind of outdated. It got worse. I don't want to even check what it looks like overnight because it is absolutely ugly. But here we talked about all of the recession fears heading the economy. This is just one side of the duality of the risk. What is the other side? The other side is inflation. See, if we didn't have an inflation problem, the Fed can cut rates and mitigate everything here and try to at least muff the shot and stop the bleeding. But we can't do that. The Federal Reserve cannot do that. Why? Because we still have huge and tremendous inflation risk. Market expectations for U.S. inflation over the 2 years have risen to 3.28%. This is the highest level since March 2023. Kathy Jones says, yikes, long-term inflation expectations 5 to 10 years spiked up again, now at the highest level in decades. So we have a big problem here. And you look at the change in pricing in core services, total core prices since the last crash. I mean, prices have been going high every year pretty much, choking the consumer regardless of the increases in pay. You see core goods also beginning to move higher since the pandemic never really went down in a big way. And this is why when you look at the chairman of the Fed, he came out speaking this week and he couldn't really give a clear answer. His answer was actually upsetting to the market, which is, I can't do anything right here. We're just going to wait and see. And he has no other choice, folks, because if he skips a step here and begins cutting rates abruptly, let's say in an emergency rate cut, with all of these tariffs that I'm about to show you right now, the insane rates of tariffs that we're about to get hit with as consumers, imagine the Fed cutting rates on top of that. Imagine the kind of surge in inflation that we're about to see. And this is why Powell doesn't want to do anything right now. He wants to wait and see until something breaks. If something begins to blow up, then he has to do the emergency rate cuts. Whether it's going to work or not remains to be seen. But right now, he's not going to do anything. And when you handicap the Fed, you introduce a huge degree of uncertainty in the market and among investors. The other problem that we have is a lot of folks say that, but what Trump is doing right now, crashing the market and introducing all of these tariffs and recession and all of that, maybe it's done by design because at least we're going to have rates going down. And that's going to be good in the long run. The problem is we haven't eliminated the inflation problem, so be careful of that assumption of all rates going to go down to zero again. They might not. Furthermore, in retaliation, this tariff war, a lot of foreign buyers of bonds, U.S. bonds, might do a strike. They might stop buying. They might begin to dump and push those yields higher. Well, guess who has the highest holding of U.S. bonds? It's China and Japan. And they've been dumping, they've been reducing their share of U.S. bonds. A lot of foreign investors are beginning to do the same, which means that maybe in this recession, we're not going to be able to lower rates too much. Not going to go back to zero again. Still going to be relatively high. And that's a huge problem in this tariff war. Now, we're going to revisit this topic again before we end the segment, because if you watch the media, of course, it's all political, it's all poisonous. And they're just going to say Trump is bad, etc., etc. But is there, at least, shall we call it, a noble kind of thinking behind it, behind all of this chaos? We'll examine that in a minute, but let's dig deep in the tariff policies that we got in the new rates, the reciprocal tariffs. This is the chart that the president showed in the Rose Garden. And everybody was, of course, confused about it, because what are we doing here? Some of the rates are not accurate. It looks like a last-minute rush where they didn't really think about it too much. But you can see here, this is the reciprocal tariffs. I mean, it's kind of hilarious to begin with when the president says we're going to do reciprocal tariffs, but discounted. Immediately, the meme of Don Draper from Mad Men comes out, reciprocal tariffs, but discounted. It's a sign of weakness. And when you do that, all of these countries like China, EU, Japan, they'll know that you're negotiating from the weaker position. And they're not going to budge. They're going to watch you face maximum pain, and for you to back off, that could be disaster for this presidency. Keep that in mind. But the other disaster is when we look at the reciprocal tariffs. You see all of these rates, China 34%, Europe, you have 20%, Vietnam 46%. But that's not it. It comes on top of tariffs that we already announced. And Sky News did a pretty good job here explaining it, so let's watch this and then come back.
Liberation Day. And let me just kind of start by showing you these bars are how high those tariffs, the US tariffs, are on various different countries around the world at the moment, or rather before Donald Trump came into office, and a quick kind of bit of revision on where we've come from so far. So threatened tariffs on Mexico and Canada. They were repeatedly threatened, repeatedly rescinded or lifted, but they might well be back again, who knows. But for the time being, they're gone. We know we got an extra 10% tariffs on China, China 1.0, then another extra 10% tariffs on China 2.0, you might call them. And we're now kind of waiting to find out what will happen next. And we finally did find it out. Let's just start. There are two parts to this, OK? So first of all, there is going to be a 10% baseline tariff. So you see all of these bars go up by 10%, including, of course, the UK. But that, as far as the White House is concerned, is just a baseline. And then on top of that, there are different tariffs for different nations, what they call reciprocal tariffs. And they say they've gone through the numbers. They've looked at not just the tariffs that other countries around the world are charging the US, but also what they call non-tariff barriers, so other things. And they've worked out, by the way, Canada, those Mexico-Canada tariffs might well come back, so we might well start from that position. But reciprocal tariffs might push all of these bars, or will push all of these bars up considerably higher. So just look at how the picture of trade and tariffs in the US has changed dramatically as a result of these measures, which are coming in the next few days.
So you see that the rates are on top of existing tariffs, and this was the worst case scenario. I made a video over the week. I said that Barclays came out and they announced that the market is pricing in 15% reciprocal tariffs. If we go to 25, who knows? That could be a bad scenario. Market can go down. But we went way above 25. In certain countries, we went above 50, 60. So that's disastrous. And of course, they're using a formula that calculates the trade deficit in determining the rate of tariffs. And that doesn't really make sense. It is controversial because we have trade deficits with other countries, but it's not a bad thing, really. I mean, we have a trade deficit with Vietnam. What do we want to do? Flood Vietnam with expensive U.S. products that nobody can afford? Not to mention, of course, a lot of U.S. companies make their products overseas, China, Vietnam, Mexico, whatever, and they ship it to other countries. So it might look like we have a trade deficit, but we're selling them products. It's just coming from a different source. And none of that is accounted for when they just look at the reciprocal tariffs. You can see the map here, pretty much every single country in the world. I mean, we're tariffing Madagascar. What is it, 50, 60% tariff? I mean, this is stupid, folks. Like this, why? Why are we doing this? I understand China, Korea, Taiwan, etc., but what does a country like Madagascar needs to do here? Just reduce the U.S. tariffs to zero? How much money are we going to make out of Madagascar? And now you have to question whether this is really worth it or not, just to squeeze maybe a $2 million extra a year from sales out of Madagascar and Tanzania or whatever. The other element that is upsetting to the market and upsetting to everybody in the economy about these tariffs, it ain't just the chaotic nature of we don't even know where these rates came from. It's the fact that the administration themselves are still confused about it. Look no further to the Treasury Secretary Bessent. When asked, hey, we have a 34% tariff, reciprocal tariff against China. Does that include the tariffs that we already hit China with, or does that come on top? Believe it or not, Bessent did not know. Take a look.
There were already 20% tariffs in place on China. So is that 34% on top of that, meaning it's a 54% reciprocal tariff on China?
I believe it is.
I believe it is? Were you even consulted about this by the administration, by the White House? Do you guys even know what the policy is and how it was formulated and what's going to happen? This kind of chaos and uncertainty is what's causing the panic. The policy itself is bad, but the chaos around it is just adding to the misery. I mean, when you look at the auto tariffs, for example, they say, oh, if the vehicle is manufactured outside of the U.S., you're going to have a 25% tariff. How do you determine that, though? Because you got cars that are assembled here, but the parts come from different countries. I mean, you look at the Nissan Rogue, 45% of the parts come from Japan, 30% come from others, and 25% come from USA and Canada, but it says it's assembled in the United States. So that's going to be immune from the tariffs? What about the parts? Because they're going to come from other countries. Is that tariff too? And if it is, then what is the advantage of buying a car made in the USA if it's going to be expensive too because of the parts? Again, it's chaos, it's uncertainty, and they have absolutely no clue what they're doing. And by the way, the chaos in the auto market right now is stunning. Nobody knows what's going to happen. Nobody knows what the tariff rate is going to be, what part is going to be tariffed, what part is not going to be tariffed, which means that all prices will go higher for new cars and used cars too. And Trump comes out, says that he couldn't care less about higher car prices. Okay, if you're going to say that, then expect a market crash. And of course, all of this weakness and the flip-flopping that he's done in introducing the policy, so, we're going to give Mexico and Canada an exemption because the market went down 2%. We're going to delay whatever, or China called when the market goes down. So all of this reflected weakness in the eyes of China, in the eyes of the EU, in the eyes of Canada, Mexico, Japan, everybody really. They knew the president exposed his weakness to everybody, that if the market goes down, he's going to back off. You don't do that, not just in the stock market, anywhere in life. You never expose your weakness early on in the game. Maybe they'll know about it later, but you don't want to expose it and volunteer to give them the upper hand as he did. So when he did all of these reciprocal tariffs, and when he threatened to do the reciprocal tariffs, the expectations were, all of these countries will come out begging and bowing and saying, sir, please, let's make a deal. Nobody did. You know why? Because they knew that the market is going to go down, the market is going to crash, and he's going to have to back off and stick his foot in his mouth. And maybe that explains the rushed policy that they've done, which looks like last minute. Even Besson didn't know about it. It looks to me that they're waiting that somebody's going to call and negotiate before the deadline. Nobody did, so they came out with whatever looks aggressive to say, you know what, we're not kidding around. And now the president placed himself in a corner. You back off, it's probably going to be the biggest weakness we've seen in presidential recent history. If you don't back off, market is going to crash. So now he's stuck in a corner. And of course, when we got the news Friday that China said, hey, we're not going to negotiate. We're going to slap an extra 34% tariff on U.S. goods. We're going to retaliate too. Then Trump comes out and says, China played it wrong. They panicked. No, you panicked. You panicked. You exposed the weakness, and now they're just going along with it. This is going to hurt China, by the way. But because he showed that he's going to back off if the market goes down, China says we don't need to negotiate, really. We just need to issue threatening headlines and hostile policies that will continue to crash the U.S. market, and the pressure will be so high, he's going to have to back off. And who benefits from all of that, by the way, the trade war between U.S. and China? First of all, China is slapping massive tariffs against our dairy products, against our farm products in a big way, where the farmers, U.S. farmers, will get annihilated. And China's now going to shift to buying stuff from Brazil. So all of this trade war is going to be good maybe for Brazil. We'll talk about that in a minute. They're buying soybeans, wheat, they're buying all of this stuff now from Brazil. Because if you're going to tariff Chinese products and then they tariff your products, demand is going to shift to somewhere where we have, let's say, a free trade agreement. Maybe China-Brazil is going to have some agreement at some point. Now, folks, when I talk about the weakness that got exposed early in this game, huge mistake, which now emboldened all these countries to say, no, we're not negotiating. We're going to hit you as hard as we can. You're going to buckle. It ain't China doing it alone. It's the EU also doing it. Perhaps by the time you get this video, overnight, before the market begins, we're going to hear the response by Europe. And the EU is now threatening a big bazooka that could be a key retaliatory tool against the Trump new tariffs. So China retaliation rattled the market Friday. The European retaliation could rattle the market this week. And then what happens after that? You're going to see retaliation again by the U.S. Trump has said there will be far larger tariffs if the EU and Canada unite to do economic harm to the U.S. So folks, again, we talk about, is somebody buying the dip right now? It's not a video game. You got to resolve this. We got to get a deal this week. Vietnam said something. Bangladesh said something. We got to get something positive out of this, because if it continues to escalate and Europe hits us with tariffs, and then we hit back with additional tariffs, it's going to get really ugly. We could see things we've never seen before, because this is wreckage in the global economy. So please be careful out there. And now Trump is saying that he vows his policies will never change after China retaliates with tariffs. Well, it's kind of too late for that. You've already projected weakness. Now you have to project strength again and show them that you're going to take the pain and not buckle. Then they're going to begin to also experience the pain. Maybe at that point, there is negotiation that could happen. But now you put yourself in a position where you have to experience that pain. You have to let the market crash. So the Chinese and the Europeans would say, you know what? He doesn't give a shit anymore. He doesn't care about the market. He's going to go full distance here. He's just stubborn. So we might have to negotiate with him before we get hit and our economies collapse. But folks, it's this flip-flopping that I don't understand. He says, oh, we'll never change the policy, but then you got the Commerce Secretary lunatic coming out and saying that 20% China tariffs could drop if she offers fentanyl cuts. So what are we negotiating here? Are we negotiating manufacturing jobs or closing the trade deficit? Or are we negotiating fentanyl? What are we doing here? Nobody knows. And then he says, oh, if China approves a deal of TikTok, we might consider removing some of the tariffs. That's weakness. Okay, you're showing that it's making you nervous. You're flip-flopping from one position to the other. Oh, we're not going to change policy. Oh, but we can change policy if you do fentanyl and give us TikTok. We might. This is all stupid, folks, and it's going to get ugly. Furthermore, adding to the consumer woes, we have fined Chinese-built container ships. These are going to be in effect. So any container ship that is made in China will be now fined. Well, guess where container ships come from? Shipbuilding, majority of it comes from China, South Korea, Japan. Nothing comes from here. And if we tariff the containers coming from overseas, that's an additional tax and tariff on top of the tariff of the goods themselves. So you ship a bunch of Mercedes from Germany. That's 25% plus who knows what's on Germany right now. And then you got to pay more for the Chinese container that is shipping it over here. It's insane. And what is the goal, really? Are we going to be a shipbuilding country again? Really? Your kids want to graduate college and do shipbuilding or manufacturing jobs? Give me a break. If we bring any of these jobs, the manufacturing jobs or the shipbuilding jobs here, guess who's going to fill them? The illegal immigrants again. And that's going to be a burden in the country because your kid's not going to work these jobs. Your sons all want to grow up and do streaming on Twitch. And your daughters all want to grow up and be whores and OnlyFans. You really think they want manufacturing jobs? Give me a break. Then we look at the steel and aluminum products under Trump administration because we have another one. Here's another one. 25% on steel and aluminum. Well, that's going to hit a lot of materials that goes sometimes in government spending, which will add to the deficit, or building, which will add to the cost of building new buildings and homes and such. And some to products that go to the consumer. It's going to add extra cost to the consumer. When you look at screws and bolts, fasteners, really important in building, a lot of them come from Taiwan. All of those are tariffed now. When we look at the trade deficit, look at what we get from China. Electronics, machinery, all other imports. We export just a little bit. European Union, we get pharmaceutical products. So your Ozempic is going to get more expensive. Vehicles will get more expensive. Machinery. What is the goal here? Are we going to sell more stuff in China? Is that the idea here? How about Vietnam? Vietnam, we have pretty much all imports, very little exports because nobody can afford our products, even without a tariff. So what are we trying to do here? What is the goal is what I'm trying to ask. So long as this confusion is the theme of the market, the theme of the economy, we're going to see horrific things. Because again, we have goods deficit with the EU, with Mexico, with China, with Canada, with pretty much every country. What is the goal here, Mr. President? Bringing the manufacturing jobs back home or closing the deficit or getting fentanyl or getting the border or what is it really? Because you will see the impact, the tariff impact, you're going to see it and it's going to hit really, really hard. It's going to hit the consumer like a nuclear bomb when things go expensive overnight. So you look at leather products, for example, they're going to go higher by 18.3%. The domestically produced products will be 2.8%, but imported products will be 21.8%. Way, way more expensive. And the list goes on. Apparel, metals, rice, electrical equipment, textiles, motor vehicle parts, rubber, plastic, metal, computer, electronics, fishing. You look at these imported products, a lot of these goods, we get them imported. So the price will go up in an insane fashion here, folks. List keeps going. Vegetables, fruits, chemicals, beverages, food, paper, sugar, nat gas, eggs, milk, all going higher. You even got water. Even the price of water is going to go higher now with all of these tariffs. So again, what is the goal here? And on top of that, you see the chaotic nature of this presidency. He comes out and he says that he's seeking a third term. Buddy, you might not even finish this term right here. So take it easy. But this kind of crazy talk also adds to the uncertainty in the market, that he's going to do something crazy by the end and try to take over and all of that. But folks, so far, based on the discussion that we had, let's try to brainstorm who's going to be the winner and the loser from this trade war. Among the winners, I think the UK will be one of the biggest winners because they have the lowest rate of tariffs, 10%, that's it, which maybe we will see UK equities performing better. Who knows? Vietnam is a winner because, yes, they have an insane tariff right now, but they will negotiate that because they don't have the leverage at all. This is going to kill them. So they're going to negotiate it. That tariff is going to go down, and we will see perhaps VNM, the Vietnamese ETF outperforming the market as it was before the recent crash when the tariffs were announced. So I expect a deal with countries that don't have the leverage, like Vietnam, Bangladesh, Cambodia. All of these countries will come out negotiating. And maybe if we get a deal with Vietnam or Thailand or Cambodia, maybe that's going to soothe a little bit of the fears and give us a rebound in the market. But without a trade deal with the biggest partners, it ain't going to happen. It ain't going to last. We're going to flush down again. Among the winners, of course, Brazil, because now China is going to reroute a lot of their purchases of products and commodities from Brazil instead. So maybe the EWZ could be EWZ's the Brazilian ETF. Maybe that's worthy of consideration. Among the losers, China obviously going to lose. So I know Alibaba and Baidu and all of the Chinese equities were doing pretty good, but they're going to get hit right now because the trade war, the rates of tariff are just insane from both sides. Canada depends a lot on the United States, and with tariffing a lot of their products, so the GDP, Canadian GDP, as you'll see in a minute, will suffer the worst hit. Germany's going to get hit pretty hard because pretty much everything we import from there is going to be tariffed more, and a lot of the German manufacturers' strategy in the U.S. was to access the middle-class consumer. So you got Mercedes-Benz doing these shitty cars that they produce here, and sometimes they ship them from Germany to access the lower-end consumer for growth. BMW doing the same thing. They're not going to be able to do that anymore because if you bring the vehicle from Germany, it's going to cost more and might as well just go with a Korean car at that point. The bad news is even Korea's going to lose big because we're placing big tariffs on them. But they manufacture a lot of stuff here. Yet there is this big ambiguity about, okay, what about the parts? Because a lot of the parts come from Korea. So that's going to be tariffed, right? But the car is not going to be tariffed. And the question now, does that really help? Then you got Japan, that's going to be also a casualty in this. There are countries that I put in the question mark right now, which is, it's bad for now, but it could be good in the long run. And that is, for example, Australia. Any commodities producer, really, Australia, Brazil, Indonesia, all of these countries. Sometimes maybe the oil producers too, like Russia, Saudi Arabia, maybe. But of course, oil doesn't do pretty good in a recession. But in a recession, we see the dollar going down as the Federal Reserve begins to cut rates and ease, and the value of commodities go higher. Australia is a big producer of commodities. They might benefit down the road, but right now, it is bad for Australia, and you saw the crash in the Aussie on Friday. It was absolutely stunning. Huge crash in the Australian dollar. Now, before moving on, there's a big question here of, hey, Mav, what if Trump is right, though? In the long run, do we take some short-term pain right now and have long-term gains? Look, I've made a video a few weeks ago with the title of, is Trump deliberately creating a recession? I said, crazy like a fox, maybe, right? I was talking about the fact that we have an insane budget deficit, which is leading to an insane national debt and an insane interest payment. That's the problem, the interest payment. We're paying over $1 trillion right now in interest alone. The only way you're going to remedy that is you have to create a recession and you crash the dollar and bond yields, because what that's going to do is reduce the interest payment and reduce the national debt. But of course, you cannot really introduce a recession without crashing the market, because we talked about the role of the affluent consumer, keeping the economy alive. And that block will only fall if we have a crash in the stock market as we're seeing right now. The other thing is, to prevent this problem from happening in the future, is we need to diversify the source of revenue that we use. And right now, we're heavily reliant on social insurance and individual income, us paying taxes. Customs, aka tariffs, just a tiny bit of the contribution to the GDP. What Trump wants to do is reverse all of this, where the majority of the revenue comes from tariffs, and then we can reduce the share of individual income contributing to the government revenue. And what that's going to do in the long run, at least in theory, is when you pay less taxes, now you have more disposable income to go ahead and spend in the economy. And sure, the tariff will be an increase on prices for consumers, but it would be all in all less than the individual income that folks pay. That's at least in theory. The problem is, of course, the practicality of such a plan. Whether the pain, the degree of the pain that we're going to get, worth it or not. Are there easier ways to do this? Because when you look at the tariff rate since 1790, we all know the famous case, of course, in 1930, when we had a trade war and tariffs. What happened? We had the crash of the stock market and the Great Depression after that. And since that time, the government hasn't been relying on tariffs for revenue for a long, long time, for decades, almost a century now. If you look at the green dotted line, under all of the 2025 tariffs to date, we're going to have a higher rate than the rate that we got, the tariff rate in 1930 that caused the Great Depression. So this is a serious shock and a jolt to the system, a serious change. We must ask, what is the price to pay for that? And is it really practical? Are we going to really raise trillions of dollars to offset the individual income contribution and taxation. There is no guarantee that that's going to be the case. We haven't gotten even an estimate of how much we're going to raise from all of these tariffs, whether that's going to be enough or not, because the price to pay is the following. When you plug in all of the tariffs that were announced in 25, the U.S. GDP will be negative. Canadian GDP is going to crash. China is going to get hit, of course, to a lesser degree. And then you have countries like Mexico, EU, UK, they might not even suffer at all. The trade war might actually be good for them, but it's going to hurt the United States, Canada, the most. Is that price really worth it? I keep asking the question again. What is the goal? Reducing the trade deficit? What is that going to do? Is it fentanyl? Is it bringing back manufacturing jobs and factories to this country? Because when you look at the value added by industry, manufacturing as a percentage of the GDP, it's been heading lower for years now. Manufacturing is less than 10% of the GDP. Is it worth to destroy the entirety of the economy to bring out some factory and manufacturing jobs? All of these jobs, by the way, will be replaced by AI and robotics. It ain't me saying it. It's Commerce Secretary Lunatic admitting that. Take a look.
Now, we're not going to have all factories come back. Like clothing manufacturing, that's tough to bring back. But what kind of manufacturing are you talking about returning here?
Well, you can't just give that away. See, what's going to happen is robotics are going to replace the cheap labor that we've seen all across the world. I mean, think of what our factories did. They went to the cheapest labor in the whole world, slave labor, cheap labor, the worst environmental conditions, polluting the heck out of it. And then we bring back those cheap products here and we feel good about ourselves because we don't see the pain.
So again, what is the point here? Because you look at all employees, manufacturing, we haven't been relying on manufacturing since the dot-com bust. Once the internet was here, it became easier just to have goods imported from overseas and improve the purchasing power and the quality of living among the U.S. consumer by accessing cheaper goods. So the question again, what are we trying to do here? What is the goal from this tariff policy? And that was never answered. And if you say we're going to bring some factory jobs, that's a bullshit answer. If you say we're going to close the trade deficit, what is that going to do? Is Vietnam really going to stampede and buy American goods all of a sudden? Not going to happen. And thirdly, will the revenue from tariffs really offset income taxes by a lot, significantly, where we actually find a tangible benefit from the reduction in taxes? Because in principle, at least for me, I'm in favor of paying less taxes and have the tariffs pay the revenue of the government. But is it practical? Is it really going to work out? Or am I just going to reduce my tax bill by, say, 3 or 4%? And then I'm going to suffer a recession, a depression, and stagflation, and increase of pricing across the board. All of these things have to be thought thoroughly, folks. And I don't think that the administration did think about them thoroughly, at least to this point. Now that we covered the macro, folks, and you see the degree of uncertainty and chaos that we see, let's talk about the market a little bit. What should we expect this week? Looking at the charts, I'm going to begin with the E-mini futures. This is, of course, at the time of the recording of this video. We're looking at a daily chart. The target from last week was 5,300. That was the Maverick target. And the chart breached all of that. Now it's trading sub 5,000. I think 5,000 is going to be a tough number where it's going to be support, resistance, back and forth, back and forth. But folks, we have severe oversold conditions right now. We have gaps outside of the daily Bollinger Bands. So the odds would suggest that we could rebound if you introduce any excuse for a rebound. I think the best excuse will be a deal with Vietnam, a deal with Thailand or Bangladesh or Cambodia, whatever, just to give a little bit of optimism that there is a negotiation process and the tariffs that we've seen last week are not permanent. Then you look at the weekly chart for the E-mini futures. This one is also oversold. It is gapping below the weekly Bollinger Bands, which you're not going to see a lot of times. Usually it's a good sign to close your shorts and begin to speculate in buying the dip and a rebound. Usually, but again, with this chaos, if Europe retaliates, then the president retaliates on top of that. It could get ugly. It could just crash the market altogether. But if you introduce any good news, I think that we should be and we're due for a little bit of a rebound at least. Here's the problem though. Might get a rebound on the daily, might get a rebound in the weekly, but in the monthly chart of the E-mini futures, we're not through yet. The crash process just begun. And whatever rebounds you get in the daily and the weekly, absent of changing the narrative and changing of the psychology by the consumer and expectations, if that doesn't change, the rebounds will be opportunities to short because the monthly chart is not through yet. Another important chart that we have to look at is the 10-year yield. Now, if the 10-year yield is heading down, crashing down, that's reflective of recession fears, and that's not good for the equities market. So what you need to look at for a rebound is a legitimate rebound in bond yields. And right now we have the gap below the lower Bollinger Bands. Things are really oversold in the bond yield chart. So if there is a rebound overnight, or let's say throughout the week, it could be an indicator for you to know that, okay, maybe I should right now take the speculation about buying the dip, or at least trading the dip, a little more seriously. Another important indicator that we look at is the dollar. So last week we were anticipating an inverse ABC crash. We got it. But now we see a little bit of a recovery, a little bit of a rebound. And if the dollar goes higher, that's going to be a good thing for the U.S. market, because if the dollar is going higher, then we're not expecting as much as recession fears as we did last week, for example. Of course, trading of foreign currencies is impacting the dollar, so the crash in the Aussie on Friday led the dollar to go higher. So we have to be careful here. If there's another currency that is crashing and the dollar is rallying based on that, then it's not a solid rally, and thus it's not a solid buy the dip signal. But if it is on legitimate grounds, nothing is crashing, it's just the dollar rebounding because we got a good piece of economic data and whatnot, then you know that's a better sign to buy the dip, or at least trade the dip for a rebound. Another important indicator is the VIX, the volatility index. And again, we look at the daily chart. Usually 9 times out of 10, when we see the hour sign, the daily, this overbought, and we see piercings outside of the upper daily Bollinger Bands, usually that's a sign that the VIX at least got a short-term top. So what we've done on Friday, because we didn't get a lot of solid signals that the sell-off is over. I was anticipating all the way till the closing hour, didn't get any good signs. I got maybe a little bit of a hint that maybe we're getting close, but not the kind of signs that I was looking for. So the only rebound trade that I've done is buying the SVIX calls. SVIX is the inverse of the VIX. So if the VIX goes down, SVIX is going to pop, maybe in, let's say, outside of a falling wedge pattern. Again, it's just a small position here, betting on a rebound Monday, Tuesday. If we see more solid signs, I'll let you know, and we'll do more aggressive rebound plays. But here comes the strategy, the Maverick strategy for the week. We talked about this in Friday's session. You got to close your April expiration puts, because the implied volatility is way too high. Things crash down big time. You're up big on your puts, April puts. But if you have a sizable rebound, the decay and the reduction of implied volatility could make you miss on a lot of those gains. So we want to book those, but keep May's expiration puts or anything that is beyond that. Because in a bear market, you want to have longer dated puts, shorter dated calls. Number 2, you got to prepare to sell covered puts on your short positions this week. So if you have a short against a stock that went down big, doesn't matter which one it is. If we begin to see signs pointing out for a rebound or some good news from the trade front with Vietnam or Thailand or whatever, you want to sell some of these covered puts on your shorts to raise cash because the implied volatility is still high. Now, you're not going to sell longer dated covered puts because that's going to perhaps screw the short position and get you out of it early. What you want to do is sell these covered puts for, let's say, 2 weeks till expiration, maybe a month max, because we're anticipating maybe a rebound to come in the short run. But again, we're going to fade the rip later on. So number 3, you can begin to speculate on rebounds via put credit spreads 2 weeks out and short dated weekly calls. So put credit spreads, because if you buy just a naked call betting on a rebound, market flushes down again, you're probably going to decay that call big time. But if you have a put credit spread that you sold on the IWM or the SPY or the Qs, and the market goes down again but then recovers by the end of the week, you get to keep the credit. So it's a safer way to bet on the rebound without solid signals, because the loss is already predetermined. Number 4, in the event of a rebound, book gains quickly and begin to double down on open shorts for May and beyond, such as fading the rip. If there's no fundamental change in the trade front, then all of the rebounds will be short-lived within a bear market. So we book the profits from the gains, rotate those profits for short bets in May and beyond. And lastly, let's move on to the conclusion of this video. What do we have on the economic calendar this week? Monday the 7th, we don't got a lot. We have Governor Adriana Zombie-Kugler, and then we have consumer credit, which is going to be important. Tuesday the 8th, we have NFIB Small Business Optimism Index, and then another zombie from San Francisco, Mary Daly speaking. Wednesday the 9th, we have wholesales inventories. More Fed zombies, this time around from Richmond Barkin. Then we have the Fed minutes from the last meeting. Then Thursday the 10th, perhaps the most important day from a macro perspective, we have initial jobless claims, but the big kahuna would be the CPI. If the CPI comes out hot, it's going to be disastrous for the market, as now you handicap the Fed big time. Of course, after that, we're going to get a bunch of Fed zombies to give us clarity, from Governor Bowman to Kansas City Schmidt to Philadelphia Harker the Chicago, the Golden Piss, Austin Goolsby. And then Friday the 11th, we finished the week with the PPI, the Producer Price Index. And then another important reading, the Consumer Sentiment Preliminary reading from the University of Michigan. Then we got a bunch of Fed zombies from St. Louis and New York. With that, folks, it's been an eventful week, and perhaps next week is going to be just as crazy. Don't miss out on the action here, folks. Join us as a Maverick member because we're covering a lot of good stuff. We're giving guidelines to all of our members. They're not lost, they're not dazed, they're not confused, they're not talking stupid, as the rest of the participants. But this wraps up the show. If you found it informative, please return the favor by pressing the like button, subscribing, and leaving us a comment. Or better yet, join us as a Maverick member to access the daily show, the bonus shows. You can find the links in the description of this video. But for tonight, folks, this is all I got for you. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
I calculate that's the end of this town.
I had a boy at the hotel pack us up. The horse is outside.
So that's why you're not wearing a bustle. A sweet, soft Hungarian devil. Well, good evening then.